epidemic cycle. However, I think there are constant risks that there could be an outbreak in another region. And we've seen in Hubei province, it's taking several months to bring an outbreak under control. So any other new outbreak outside that region is just going to extend this whole situation by another several months.
Imogen, the last time we had you on, you just reduced your growth forecasts for China for the year. Is there a sense now that the authorities have got to grips in terms of economic stimulus? We've had we've had rate cuts, for example, spending commitments from the government.
Yes, we've had, I think, especially fiscal policy. They've been very forthcoming in terms of tax cuts, tax rebates. And we can also expect quite ambitious infrastructure building this year. Today, for example, we saw a huge package of infrastructure programs announced for Southwest Yunnan province. So we can expect a lot more high-speed railways, bridges, and the like being announced this year. And we've also seen some property sector loosening. Some smaller cities have removed the price caps for housing in those areas, and that will also help to cushion the effect of this virus outbreak, especially in the second half of the year.
I guess, Charles, if there's a concern at this side of the world, it's that the authorities don't have that much firepower to stimulate the economy if they need to.
Well, I think this will be a different situation, and that the fiscal rules that have been set up for a normal economy will be broken because people will need to stimulate activity. So just as China has taken aggressive action, I'm sure once Italy gets under control, the EU will be looking to stimulate the northern part of Italy to rebuild tourism, to make sure that the economy gets back on its feet as quickly as possible.
Is there any sense in your mind that we might be talking ourselves into a bit of a downturn in Europe?
I don't think we're at that stage as yet. No, clearly the virus has only just appeared with any degree of seriousness, and that could carry on. So I don't think it's a downturn that the market will be worrying about. It's just that it's going to be a dislocation of supply chains. A number of companies are going to see the short term impacted. But we'd expect to see a recovery relatively quickly once the virus gets under control. It may take a number of months, but I think we'll see stimulus packages taking place in order to make sure economic activity picks up.
Well, Imogen, we've seen a slowdown in new cases in China. South Korea, we've seen a big uptick in new cases there. At what point will you start looking at your growth forecast for there?
Yeah, so we have already revised our real GDP growth forecast for South Korea this year down to 2.1% from 2.2% previously. Now, with the news today that there's been a huge new rise in cases in the fourth largest city, we'll be looking to revise down our GDP growth forecast further.
All right, Imogen Page-Jarrett in Beijing, Charles Hall here in London. Thanks both. Right, sourcing products from China, but it warned that if delays to factory production were prolonged, the risk of supply shortages on some lines later this financial year would increase. Well, Associated British Foods said that a number of its food businesses, which includes brands such as Ryvita, Dorset Cereals and Jordan's, had operations in China with its factories operating, but at reduced capacity. Business supplies group Bunzl said today that the coronavirus outbreak is sort of a non-event. Frank van Zanten said that although the company sourced products from China, stocks were relatively high because inventory had been built up ahead of the Chinese New Year. He said that Bunzl, whose products include food packaging, safety equipment and paper cups, could also switch its sourcing to other countries such as Thailand, Bangladesh and Malaysia if required. Well, Bunzl reported a 2.4% rise in full-year pre-tax profits to £579.1 million on an adjusted basis. Now, there are just 16 days until the budget. The new Chancellor, Rishi Sunak, hasn't had that many more in which to prepare it, having taken over from Sajid Javid just 10 days ago. Well, all the talk is that there will be a big boost to spending, especially on infrastructure and ways to level up growth in the north of England. But the left-leaning think tank, the Resolution Foundation, says that may require tax increases, as tweaks to the government's fiscal rules wouldn't be enough to cover increased spending. Well, Resolution Foundation's economist Jack Leslie joins me now. Jack, welcome to you. I mean, very interestingly, you think the Office of Budget Responsibility is going to give the Chancellor a little more fiscal wriggle room?
Yes, so that's one of the surprising things we found in our report. So the outlook for economic growth has deteriorated since the OBR made their last forecast back almost a year ago. But actually a bigger factor has been that both inflation and interest rates have fallen materially below their expectations, and that reduces the cost of government debt.
But overall, under the current fiscal rules, he still doesn't have really that much room for manoeuvre.
No, exactly. So we expect that there maybe has £10 billion of fiscal headroom left, and that would be the, assuming they didn't spend any of that on additional spending measures or reducing taxes, that would be the joint lowest fiscal headroom of any new set of fiscal rules since 2010. So it's really quite close to the wire.
So one option that is open to the Chancellor is to sort of tweak the fiscal rules so that he only has to balance the budget on a 5-year rolling basis. Why wouldn't that necessarily be a good idea?
So that's one of the things that has been suggested quite a lot over the last week or so. And the reason is that it doesn't really buy the Chancellor very much, because it just slightly offsets the delays the point at which the government needs to be able to balance its budget. And so it only adds about maybe £5 billion to the fiscal headroom.
Why are we talking about extra spending right now anyway? I mean, this isn't exactly the point in the political or economic cycle where you'd normally see fiscal largesse, is it?
So I think one of the key things is that we've seen that across a range of public services, a deterioration in the quality. So, for example, back in 2012, the proportion of people waiting more than a week for a GP or nurse appointment was 13%. Last year, it had almost doubled to 25%. So there are real pressures on public services. And that's why the government is probably going to have to loosen the purse strings a bit in order to drive some improvements.
But isn't there a danger in terms of tearing up the fiscal rules when it comes to current spending, day-to-day spending? I mean, these aren't going to be really productivity-enhancing areas of spending compared with longer-term capital projects where there appears to be plenty of money.
That's probably the case. So as we've seen, there's likely to be substantial additional investment, but on the current spending side, any additional investment, any additional spending now is probably going to have to be financed by tax rises, because, as you say, this is not the right point in the economic cycle to be increasing spending by borrowing more. That would be not a credible approach for the government to take.
Is there really any point in this day and age in having fiscal rules? I mean, they're all very well for a Chancellor that wants to prove to the market that he's prudent, and I guess it reassures investors. But with government borrowing, gilt yields are so low anyway. I mean, there's almost no risk in borrowing more, is there, right now?
So I think there are two key things. There's a practical consideration, which is that fiscal rules really help the government to be able to set its own spending. So when the departments, the Treasury is debating with the health department, with MOJ, etc., it's helpful for them to have a set amount of spending that they can do. It's also the fiscal rules are sort of reflect the underlying truth that you can't borrow to finance things over time. There needs to be a relationship between the amount that you spend and the amount that you raise in taxation, and they're just reflecting that sort of underlying truth.
All right, Jack Leslie from the Resolution Foundation. Good to see you. Thanks for joining me. Well, the oil price has taken a real whack on concerns about what the spread of coronavirus will do to demand right now. A barrel of Brent crude will set you back $56.17 a barrel. That is down by just under 4%. Well, no real surprise then to see the FTSE 100 being dragged lower by the oil heavyweights. BP and Royal Dutch Shell have on their own clipped nearly 40 points from the index on their own. Overall, as you can see, the index is right now down 3.5% in a fairly broad-based sell-off. In percentage terms, the biggest faller by some distance is EasyJet. It's off by over 15%, as you can see there. TUI, the tour operator, not too far behind it. That is 8% lower. There are not too many gainers to mention, as Charles Hall said earlier on in the programme, but Bunzl mentioned them a while ago. Well, they're up by 1.75% on their results. Well, Pearson is also ahead by nearly 2%. You might remember seeing its chief executive, John Fallon, here on the show last Friday. Well, outside the FTSE, it's a pretty similar picture. Heavy selling all the way across the index. The hotel operator PPHE, owner of the Park Plaza chain, is off by some 10%. Elsewhere in Europe, pretty similar picture. All of the main indices are lower. On the currency markets, the safety play currencies such as the Swiss franc and the US dollar are in demand. That means that the likes of the euro and sterling are lower. The pound currently close to a 3-month low against the US dollar. It's also slightly lower against the euro. Accounting scandals, botched reporting, questions over financial health all have hit the share prices of listed companies or even led to their collapse. Well, there are plenty of prominent examples, the likes of Patisserie Valerie, Aston Martin Lagonda, and over recent weeks, NMC Health shares have also tumbled. Fund manager Tim